I'll call this meeting of the 89th annual meeting of the United Cooperative to order. Good afternoon and welcome to the 89th annual cooperative meeting. It's been determined that a quorum is present and therefore I call this meeting to order. Secretary Robin Craker will read the notice of the meeting and the minutes of last year's meeting.
Okay, thank you, Howard. Official notice of annual meeting, April 24th, 2025 at 1 p.m. The Watermark, Beaver Dam, Wisconsin. Purpose to review the Board of Directors and Management Report on the business year, January 1, 2024 through December 31, 2024. To present the board election results, to transact such other businesses may properly come before an annual meeting of its members. Cooperative, Howard Bull, Board Chairman, Robin Craker, Secretary, David Kramer, Treasurer. Minutes from the April 25th, 2024 annual meeting. The 88th annual meeting of United Cooperative was called to order by Chairman Howard Bull at 1 p.m. at the Watermark at Beaver Dam. It was determined that a quorum was present. Secretary Robin Craker read the notice of the meeting and the minutes of last year's meeting. With no corrections, the minutes stood approved as read. Chairman Bull gave his report and introduced the Board of Directors. President Kramer presented the annual report of the balance sheet and the statement of operations for 2023. President Kramer reported total sales of $1,358,331,208, a net margin of $112,729,374, total assets of $1,081,394,269, patron equities of $710,645,381, and cash returned to members of $61,937,000. A motion and second came from the floor to approve the financial report. Motion carried. Howard Bull gave the nomination committee report and announced the election results. Members of the nominating committee were John Stevenson, Chris Ruckert, and Michael Bull. Re-elected to the board were directors Jordan Crave and Robin Craker. Newly elected to the board was Luke Bergman. Chairman Bull thanked outgoing director Greg Talkin for his years of service and welcomed Luke Bergman to the board. Old business, none. New business, none. Chairman Bull made his closing remarks and noted that the meeting has been recorded and would be available for review via the website. A motion and second came from the floor to adjourn the meeting. Motion carried.
Are there any additions or corrections to the minutes? Hearing none, the minutes will stand approved as read. At this time, I'll introduce the Board of Directors. Our Vice Chairman, Gary Nolden. Secretary Robin Craker from Reesburg, Luke Bergman from Ellington, Jordan Crave, Waterloo, Dwayne Hinchley, Cambridge, Brad Krieger, Shawano, Rod Liederman, Denmark, and Peter Milsna from Hillsborough. At this time, I'll turn the meeting over to Dave Kramer for his report.
Thanks, Howard. I guess we'll start the report talking about our balance sheet. As I said earlier, it's our 89th annual meeting. I think this is the 42nd time I've had the fortunate ability to present these. I guess it's another great year. Not quite as good as last year, but it's still a very good, stellar year for us. The balance sheet, we'll talk about current assets first. You can see our total current assets are $483,500,000 versus $556,968,000. The big changes there, I guess, would be cash and cash equivalent is up $16 million from a year ago, $50 million this year versus $34 million last year. Our inventories are down just slightly, $353 million versus $362 million a year ago. And then we have prepaid expenses down about $7 million, $37 million compared to $44 million. Then we have income tax refundable. This is new this year, up $14,177,000. We're fortunate we're going to be able to recoup some taxes that have been paid the last several years. The current assets is another big change. It's $3,000,007 versus $79,618,000. This is basically, most of it is investments, excess cash that was invested. So that makes our overall current asset value $73 million less than last year. This is the big portion. Investments in others, and we'll talk about that. That's where the $73 $76 million went. You can see it's investments $291 million versus $191 million. This was last June. I think everybody's probably aware that we purchased the ethanol plant in Necedah, and that's where the cash was spent at. Other assets that are $3.9 million versus $3.8 million. Total investments in others are $295 million versus $195 million, $100 million more than a year ago. That's because of their investment in UEN. Then we go to property, plant, and equipment. I think everybody's been aware that we've been in a pretty aggressive building phase with property, plant, and equipment. You can see we've got $674 million of property, plant, and equipment versus $590 million the year before, up $75 million. Then we have accumulated depreciation. Obviously, if you have more assets, you're going to have more depreciation. So we got $292 million in depreciation versus $270, so our depreciation is up approximately $21 million. So our net property and equipment is $381,664 versus $329,059,000, up $52 million approximately from a year ago. Our total assets then are $1,160,592,000 compared to $1,081,394,000, up about $79 million from one year to the next. Then we get into our current liabilities. So our total current liabilities are $313,538,000 versus $309 million, just up about $4 million. Not much of a change there. Big thing is the current maturity on long-term debt, $16 million versus $13,640,000, up about $3 million. We took some additional, a small portion of a current debt last June. Short-term debt, we have $9.4 million. At the end of the year, we were into our short-term borrowings. That amount, those currently been paid back, so we have no short-term borrowings at the present time. We actually have excess cash of about $35 million at the present time. Accounts payable, $43 million versus about $43 million. It's about the same as what it was a year ago. Grains payable, $53 million versus about $63 million, down about, well, it's not quite $9 million from a year ago. Unrealized loss from forward contracts, about $2 million. Taxes payable, $2.5 million versus about $2.1 million. Patronage refunds payable in cash, $24,327,000 versus $33 million. So it's down about $9 million from where it was a year ago. And we'll get into that when we talk about operations, the reason for that. Patron prepayments and credit balances, you can see a good support there, $141,000,008 at the end of the year versus $131,009,000, up about $10 million at the end of the year. To date, we hit a high of almost $180 million of prepay within the first part of March. You're now starting to reduce because some of the products are being delivered to the farms. Income tax payable is $0 this year. Last year was $2.4. We have other of $5.4 million versus about $4.6. It comes to the total current liabilities then of $313 million versus $309 million, $4 million difference. Long-term liabilities less current maturities is $72,850,000. Last year was $60,950,000, up about $12 million from a year ago. Remediation payable, $667,000 versus $318,000. Deferred income tax, $13.5 million versus $274,000, an increase of about $13 million. So our long-term liabilities then are $87 million versus $61,005,000, almost $25 million more than they were a year ago. Total long-term liabilities then are $400 million versus $370 million, up $30 million from a year ago. When we get into our patron equities, preferred equities, this is our preferred stock program. You can see at the end of the year we had $224 million of investments in preferred stock by our members, employees, and customers. $220 million a year before, up about $4 million. So that continues to be maintained and grows slightly. Our equity credits, $151 million versus $141 million, up $10 million from a year ago. Patronage refunds payable in equity, $24 million versus $33,009,000. There again, it's $9 million less because our patronage rate is 50% cash and 50% equity. Our general reserve is growing nicely. $360 million in general reserve versus about $315 million a year ago, up about $45 million from one year to the next. So you can see our general reserve is substantially larger than our preferred equities. So our patron members in preferred stock are very, very safe. Total patron equities then are $760 million versus $710 million, up about $50 million from one year to the next. Our total liabilities and equities then are $1,160 million versus $1,081 million. So you see, we have a balance sheet, assets balanced with our equities and liabilities. So you go across the page to the pie chart, it shows the percentage of what's owned in the company, and you can see the biggest percentage is inventories. There's about 30.49% of the company assets are inventories. The next is property, plant, and equipment. It's about 32.89%. Actually, that is the biggest portion by a slight amount. In investments, $291 million, 25.11% is the third largest. So, and you can see our cash is about 4.34% of our overall asset base also. So that's $50 million. It's substantial. So one thing that we differ from other cooperatives are investments. Our investments are not just paper, they're a lot of brick and mortar because of all our investments in our ethanol. In the ethanol industry, we're invested in 4 different plants. So that's a big plus for us versus some of the other cooperative competitors. And if you go across the sheet, you can see total assets in the 5-year history. You can see they continue to grow. We're up almost $80 million in assets from 1 year ago today. So we've got steady growth there for the last 5 years. Patron equities, also good steady growth. You can see our patron equities, $760 million versus $710 a year ago, up $50 million. The pie chart there, liabilities and patron equities. You can see our patron equities are 65.49% of the pie chart. Long term is 7.49%, and current liabilities is 27.02%. So patron equities, percent of the pie, have gotten bigger. And there's a picture on the bottom of the page that shows our new facility up in Waupun, our new feed and grain and bean processing facility that's under construction. We flip the next page and we'll get into the statement of operations. Our sales this year were $1,186,792,000 versus $1,358,331 a year ago, down about $171 million. When you get into our volumes, you'll see all of our volumes are up other than our fuel volumes. What we're dealing with there is commodity pricing. Primarily the commodity prices of grain is what's affecting the overall sales of the company. Then we have gross margins, $165,776,000 versus $169,469,000, down about $4 million. So basically a percentage is up slightly, 13.97% versus 12.47%. And obviously as the price of commodities go down and you keep your margins similar, your percentage is going to go up. Then we'll move into operating expenses. You can see the first category is merchandising expenses. Total merchandising expenses for the company are $72,608,000 versus $72,439,000. So we were able to do a very, very good job keeping our merchandising expenses in place. The biggest portion of that is salaries and wages. You can see our salaries and wages are $54,958,000 versus $52,938,000, up $2 million. And that encompasses, we had two raises this past year, one in September and one in April, one in October of this past year. So we're able to maintain our overall salaries and wages by controlling overtime in the company. The less wage reimbursement, these are wages that are paid to the ethanol industry. Those employees are all under our umbrella, and this is the amount that was paid out to the ethanol companies that we have ownership and operate in. So, other than that, everything else there is not much of a change. And operating expenses. You get into total administrative expenses, they're up slightly, but very, very, very marginal. $2 million versus $1.7 million, 17% basis points versus 12. We get into the general expenses, and these are the areas where you're going to see the biggest changes: depreciation, amortization, $37,108,000 versus $33,553,000. As we add $75 million worth of assets for the year, you know, when they come into service, the depreciation starts. So you can see our depreciation's up $3.5 billion, and we have several large assets that are in service at this point. When they come on, this depreciation number will get a little bit higher. Whether you got to realize this is a non-cash expense. So. Insurance, there again, as we have more assets, insurance costs are going to be going up. We have to raise liabilities so that they're insured for loss. So we have $4.7 million versus $3.6 million. It's up about $1 million. Property tax, there again, that also goes up with more assets. $2,464,000 versus $2,060,000, up about $400,000. Education, rent, and miscellaneous, $834,000 versus $905,000. It's down slightly. Total general expenses then are $45,153,000 versus $40,142,000, up about $5 million from a year ago. Then we have interest in other expenses or income. With the bracket here is income. We have a gain of removal of property and equipment of $3.5 million. Last year we had $733,000 gain. This year we had several other C-stores that were liquidated and had substantial gains on some of those. Finance charge income, $298,000 versus $445,000. Then we have purchase discounts, $936,000 versus $1,098,000. We looked at our discounts on the upper portion of this. We didn't even talk about that, but we also get discounts for paying our bills net 10. So some of those discounts are passed on, the cash discounts, to our members for also doing the same. In our other revenue, you can see we have $12,604,000 versus $9,278,000. That's up about $3 million. This is interest or income dividends generated from our invest line with the company. And last year we had substantial amounts of excess cash, so we were generating quite a bit of income through that. Interest expense, $804,000 versus $813,000, so interest expense is about the same. Collection and other expenses, $1,053,000 versus $778,000. So primary to that is collection is very minimal. It's other expenses. We have soil samplings and other things like that that get lumped into that category. So total interest and other expenses or income, we have income there of $15,488,000 versus income last year of $9,964,000. Then we have net operating expenses of $104,313,000 versus $104,325,000. Local net margin, $61,462,000 versus $65,141,000. Down about $4 million. And this is margins exclusively from the cooperative. Then we have income affiliates. This is the income that is generated from our ownership in the ethanol industry. $36,452,000 versus $47,522,000. So it's down about $11 million. And that primarily is what's affecting our cash distributions, is the loss of income in the ethanol industry. And if we look back, $36 million is still very, very good. $47 million was exceptional the year before. We've had several exceptional years there. It's really been complimentary to the company. And we have patronage refund received. This is patronages that we get from CoBank, CHS, and Land O'Lakes. And the primary ones, we get a little bit from the ACE hardware also. $9,891,000 versus $11,337,000, down about $1.5 million. There was down a little bit with what's going on in the energy business with CHS. Was down just a slight bit. Net income before income tax at $107,806,000 versus $124,001,000. So down about $16 million. And obviously we have to pay some income tax, $8.3 million versus about $11.3 million. That income tax is down about $3 million. And net margin then comes out to $99,540,625, 8.38% versus $112,729,374, 8.3%. Down about $13 million, but percentage-wise pretty close to where we were a year ago. Our patronage rates for the upcoming patronage Distribution are going to be, farm supply are going to be 7.5% of your purchases. Grain will be 6 cents per bushel. That'll be down slightly. Obviously, the last harvest, everybody knows, was very dry, so our revenues for drying and storage were substantially less, so that's why this number is less. Grain storage and drying is also 5%. It's down from a year ago because of the same situation. If you go across the page, then we got our total sales, breakdown of the total sales, and you can see that grain and trucking is 46.06% of our overall sales for the year. Agronomy is 23.46% of our overall sales. Feed is 25.58% of our overall sales. And then we have our energy and retail is 4.9%, which is a small portion of our overall portfolio. Drop down below that, and you can see that we have volume reports. We have feed is in tonnage. You can see what the 5 years bar chart there. You can see a nice growth in feed, 490,267 tons of feed versus 434,162. And this is only our new mill just came on in middle part of October. It's really just starting to get ramped up by the end of the year. And we continue to have very, very good margins, very good increase in sales there. It's surprising the attention that a new mill of that stature draws and brings a lot of business into the company. So we're very pleased because it is a big investment. We expect it to grow, and it's built for growth. So the next one to be dropped down to the bottom is fertilizer tons. There again, you can see we're down slightly, 335,000 tons versus about 314,000 tons the year before. We had a wet fall, if you remember, and December was not good. Like the year before, December we were spreading fertilizer all the way through December. This year was not that way. There again, we had lower commodity prices on corn and beans, and had some people were cutting back because everybody was anticipating maybe fertilizer prices were going to come down. Probably unfortunately for the farmers, they did not come down. So we're anticipating a huge spring. We have a lot of product sold, and just need to get it on the ground. Then we have grain volume, bushels in millions of bushels. You can see a nice growth there. This is what we've sold. Marketed for the year, 85, almost 86 million in 2023, and over 100 million bushels of grain marketed in 2024. So we had nice growth there, and as we add storage, that business is growing nicely also. So fuel volumes, you can see there again, they're down slightly from the high of 27 million and down to 21,000,001. There again, obviously when we sell some of our retail facilities off, that's going to take volume away from the company. We had a warm winter, warmer than normal last year, affected the propane gallonage use. And I report this year has not been that way. We are up about 5.4 million gallons on propane sales from a year ago. So we have a very, very strong first quarter in propane for this year. The next page talks about the net income for the last 5 years. I just combined the last 3 years. We had 3 real tremendous years. 22 was 106 million, 23 was 112, almost 113 million. This year was almost 100 million. $319 million of income in the last 3 years. That's very, very good. If you look at what's going on with some of our neighboring cooperatives, that's substantially better than what they're performing. Our annual sales, you can see our annual sales drop back off. It's like I said earlier, it's a reduction in commodity pricing is what's driving that. Primarily grain, because obviously you see grain is a big portion of our portfolio. Return on equity has dropped off a little bit from 5.86 to 13.1, but still a very good return on equity. I guess if you were investing money and getting a 13% return, you'd be pretty happy. So, cash returned, there again, nice amount of cash returned for the last 5. The last 3 have been exceptional, 55,000,004 versus 61,000,009 and 56,000,088. Last 3 years, it's almost $175 million in cash returned to our members. So it's phenomenally good. Then the last page is a net margin based on $100 of average sale of $100. You can see just flows through, and you can see the net margin is $8.38. Last year was $8.30. The big difference there is income from affiliates. Last year was $3.50. This year was $3.07. Actually, the local net increased to $5.18 versus $4.80 a year ago. Very, very solid. The company is very, very solid. What we're doing for the upcoming year, we're finishing up on some of our projects that have been going on. Some of them have been going on close to, the planning's been going on for 3 years for some of these, and some of them have been going on construction for 2 years. Our big project that's in the process of getting closer every week is our soy processing facility. We're anticipating that facility will be in operation by the soy harvest in September. So we'll start manufacturing quality bean meal in September with that. Everything goes as planned. Feed mill is like I said earlier, is running well. We've got a few tweaks there that we're doing, and we got some rail infrastructure is being finished up at Center Valley. The grain facility there is going to be totally complete here in the next couple weeks, so that'll be operational for this year. La Pond, we had another bin that's just being jacked, another 800,000 bushel bin jacked for our bean facility there. That'll be done here in a week or so. And then we've got the infrastructure that goes along with that, put conveyors in and rail scale and things to bring beans across to the soy processing facility. And we're also putting in a rail facility, or upgrading our rail facility in Ripon South, where we'll be able to putting weights, so a rail scale in there and some additional trackage, so we'll be able to load 50 car unit trains there with weights, where we don't have weights in the present time. And that's having weights is a big thing, because all your buyers, they want to know what, and we'd like to know what we're sending down the track too when they get loaded, so it's a big plus. It opens up some markets for us. We'll actually be able to, we're working on a program where we'll be able to load 110 car trains out of Center Valley too. We're very close to having a rate that'll be workable with the railroads up there, so that'll be a big plus for us up there. It'll give us additional advantages over other competitors up there. Our unit train loader down in Boscoville is performing very nicely. I think we've got 15 or 20 unit trains to load yet before harvest. That's worked out extremely well for us. And we also have our reload system down in Fall River, where we're bringing in potash direct out of Canada. That's saving us substantial amounts of money servicing our fertilizer plants. And I think maybe just go through with fertilizer plants. We added storage at Hillsboro. We added about 2,400 ton of storage there. That's complete. We put a 150-ton tower up at Westfield. A new plant. There was a picture in the annual report of a new plant at Mayville. That's taking the place of the plant that was at, obsolete plant that was at Hartford, and an obsolete plant that was sitting in the village of Mayville. So it's right on Highway 33, just, we call it Brown's Corner, I guess it's the title for that area. So that one's completely operational, ready to go. We've added 12,000 square foot of warehouse and a liquid plant up at Coleman. That's operational. We also had with our plant at Horicon, we've added liquid storage and a spray shed there also. So we're making things more efficient. Johnson Creek, we've reworked that whole plant at Johnson Creek. Put all new concrete bend structure inside, a new receiving system outside, so we're actually able to receive fertilizer there and unload trucks now in a realistic time, about 15 minutes a truckload. In the past, it was close to 45 to an hour if things worked. So that's all been redone, so we're in good shape there. So we feel really good about where we're at, and get some things finished up. And we've got a few projects in place. There's a few grain projects that are working on for the upcoming year. Maybe we have a couple fertilizer facilities that are getting a little tired that we're looking at the replacements. So we have to continue to reinvest. So with that, that is my financial report. Howard.
Okay, thank you, Dave. Before I ask for a motion, I'd like to extend a big thank you to Dave and his team for the excellent job they've been doing over the years. there's no word to describe it other than phenomenal what's been accomplished. At this time, I need a motion and a second to confirm the financial report. Is there a second?
Second.
Motion's made and seconded to approve the financial report. All in favor say aye.
Aye.
Opposed? Motion is carried. At this time, I'm going to call on Gary Nolden, our vice chairman, and he will give the nominating committee report.
The nominating committee members were Jay Vomastik, Adam Rademacher, and Jim Van Aaron. The nominees put forward were Brad Krieger from the North District, unopposed, Dwayne Hinchley from the South District, unopposed, and Howard Bowl and Travis Morse from the Central District. Travis Morse was elected in the Central District and will be joining the Board of Directors. Travis is with us today in the rear. I would like to thank Howard on behalf of the board and all the patrons of United Co-op for his many years of service on the board and for all of the work and dedication he has put in his long-time duty as chairman of the board. And I would ask for my members right now to join me in a warm appreciation for Howard.
At this time, is there any old business? Any old business at all? Is there any new business to be brought up at this time? No new business at this time. Once again, I would like to thank our patrons for the business they've done with us this past year and in the past. Without your support, none of this would be possible. With that, I call the meeting adjourned, and I'd like to thank everybody who's tuned into this. But there will be a reorganizational meeting after this. Thank you.